Okay, everyone. I'm just gonna wait another minute or two as people are coming in. And we have somebody whose hand is raised. Um, Helena, you have a question?
Yes, I just wanted to know if you can hear me.
Yes, I can hear you.
Okay, I wasn't sure because I'm not going to be on the video, but I would like to make sure that I'm in.
Okay, yes, you're in. You will be, everybody will be muted, but if you raise your hand, we can call on you and you can chime in, okay?
Okay, thank you.
Okay. Okay, I think we can go ahead and get started. Welcome to our webinar on minimizing estate taxes for your family. I'm here with my colleague, Joe Stackhouse. We're from the Village Law Firm, and we just want to give you a high-level overview of what estate taxes are like both at the federal level and at the state level. We'll be focusing on New York State, and we'll just talk about how that works and some strategies that you might use to minimize those taxes. If anyone has any questions along the way, you can feel free to put them in the Q&A or the chat or raise your hand, and we can get to those either during the presentation or afterwards if we feel like it might be better to address those afterwards. Okay, just an overview of a disclaimer that this presentation is just for educational purposes only. You should really not use this to be making decisions about how your estate looks or making gifts. You really need individualized advice for your particular situation. And this is, I'm going to kind of stress this even more in this particular situation because we are giving a high level overview. All of these things, there's exceptions, there's different specific aspects of these things that we might not cover. So because this, we don't have time to give like a full college level course on estate taxes, but he'll give you an overview to see if this is something that you need to be concerned about, who to talk to, and when issues might arise. About us, I'm Shannon McNulty. I'm an estate planning attorney and founder of the Village Law Firm. I have my advanced degree in taxation, and I also have a certified financial planner designation. So we really try at the Village Law Firm to provide our clients with a holistic plan and service to make sure that their loved ones would be taken care of, and that their assets would be protected. Joining me is my colleague Joe. Joe, do you want to introduce yourself?
Yeah, so hello everyone. I'm Joe Stackhouse. Like Shannon, I also have my advanced degree in taxation, and I primarily handle the estate planning and tax planning side of a village law firm.
Okay, great. And what, we're talking specifically on this webinar about estate taxes, but what we do generally is really looking at a holistic view of just making sure that your family will be well cared for and protected if, God forbid, something happened to you. And we do that by making sure that your kids are in the hands of somebody who you trust. So making sure there's a guardian for your kids, making sure your assets would be accessible to your family. They're not going to be tied up in court bureaucracy, protecting your kids' inheritance so they don't get it when they're young, or that it wouldn't be end up with maybe if a spouse ends up remarrying, it's not going to be depleted that way. Minimizing taxes is part of it, but really having a comprehensive plan so that, you know, if the worst did happen, that at least your family would have a solid plan to make sure that they're cared for. So, and I kind of deliberately put minimizing taxes lower on the list because honestly, that's kind of something that all of these other things are actually a lot more important, or at least some of them. Like who's taking care of your child on a day-to-day basis, that's way more important than your taxes, especially in this situation where you're not going to be paying taxes unless you have a certain amount of money. So it's not like your kids are going to be going hungry because there's taxes being paid, but these other things of making sure your kids are in the care of somebody who you trust, making sure that that person has all the information they need, whether it's information about allergies or doctors, things like that, making sure those assets are accessible and that your family isn't kind of struggling and trying to figure out where assets are and how they can access them and getting tied up in court. So all of these things are like really important. So, you know, taxes are important as well, but they are just part of a plan. And just to kind of give you just even an overview of or an idea of what things happen that we see, the biggest problems are not in taxes. I got an email from a former client of mine saying her friend had a brain hemorrhage. She has a young child and a husband, and they don't have a power of attorney for her. So they can't sign anything for her, any kind of like documents that need to be signed. They're having a lot of problems. And she said, well, can we do a power of attorney? Can she do a power of attorney now? Can the husband get a power of attorney now? And I said, no, it's too late. Somebody is unconscious in the hospital, you can't do a power of attorney. And this is actually the second time this has happened this week that I've heard of something happening like this, where the only alternative to that is going through a guardianship proceeding with the court, which is extremely painful and burdensome, and it can take a long time. So really, like I said, these other things can be just as important. And so I don't want people to just be focusing on the taxes. It's really about coming up with a comprehensive plan. And the taxes come into play of kind of, we want to look at them in the context of what your assets are. And we want to look at kind of like what your assets are and then what your liabilities are, because those are going to be deducted in terms of what you're leaving your family. So when you're looking at your estate, you want to think of everything that you own. Sometimes people think, oh, I don't really have that much. You know, I have my house, or I have, you know, a brokerage account. They might not be thinking of business interests that they have. They might not be realizing how much, if their house has appreciated in value, that's going to apply, that you're going to be looking at the higher value for your house. Any life insurance is going to be taken into consideration and what your estate is. And then you would deduct sort of, if you have a mortgage, then you know, that's not going to be available for your family. Any estate taxes, whether that be state estate taxes or federal estate taxes, that's going to deduct from what you leave your family. And then as well, income taxes. So, and this is specifically with respect to retirement accounts. So while those can be left to your family, when those accounts are paid out, then the taxes have to be paid on those. So so that's sort of a way that money can be deducted from what you're living. So just an overview of how the federal estate tax works. The federal estate tax is actually a coordinated tax with the gift tax. And you can think of this, often we refer to it kind of in the legal sphere as a transfer tax, because it's a tax on any transfers made during your life or upon your death to another person. So that's what that tax applies to. And what we often refer to as the estate tax exemption is actually a lifetime exemption, meaning that you can give a certain amount of money to other people during your life or upon your death, up to a certain amount without it being taxed. But that exemption, it's an accumulative exemption of all of the transfers during your life or upon your death. So just for example, if you gave away, say the estate tax exemption is $7 million. If you give away $3 million during your life to your kids, and then you'll have a $4 million exemption upon your death. So that whatever you give away during your life is deducted from that overall exemption. And right now in 2024, the estate tax exemption is $13.6 million per donor. What that means is that any one person, again, can give away that much money without it being taxed. And the tax is on the person gifting it. So if you, during your life, it's on the person making the gift. Upon your death, it's on your estate. So it's not, you can't give a certain amount per donee, per person. It's total accumulation of you during your life and on your death. That number right now, 13.6 million, is the highest I think it's been historically. Under the current rules, the estate tax exemption is going to be cut about in half at the beginning of 2026. So January 1st, 2026, we no longer have a 13 point whatever million dollar exemption. We now have a $7 million exemption, which is still quite generous in comparison to a lot of other countries, but it is substantially lower than what it is now. And while the estate tax exemption is quite generous, the estate tax rate is quite high. So anything that goes over that exemption is going to be taxed at 40%. And I will mention as well that this exemption is for US citizens and US residents. If you are not a US citizen or a US resident, then there's a whole other presentation that you should attend. So just let us know and we can send that to you. And I'll also mention, I see somebody is here from Pennsylvania, that Pennsylvania actually has an estate tax. It has no estate tax exemption. So while the estate taxes rate is low, there is no exemption. So all of the states, and we'll get to New York in a little bit, have kind of their own rules for estate taxes. Okay, but again, going back to the federal taxes, there are certain transfers that are tax-free that do not count for that that lifetime gift and estate tax exemption, that lifetime exemption. You can gift up to $18,000 per year to per donee without it affecting that lifetime exemption. You can pay healthcare expenses without it affecting your lifetime exemption. You can pay certain educational expenses, and also any gifts or bequests to US citizen spouses are also tax-free. If your spouse is not a US citizen, then that does not apply to them. There's a little bit different rule that applies to gifts to citizen spouses. Okay, so I have a question. The exemption is cumulative, so how do you leave that to your kids? So we'll get into kind of like what the strategies are in terms of leaving things to your kids. But yes, the exemption is cumulative. So you just want to keep in mind anytime that you're making gifts to anybody else, then that's going to affect that overall lifetime exemption that's left like when you pass away. Okay, so another aspect of the federal estate tax is what we call spousal portability. What this means is that the surviving spouse can use the deceased spouse's unused exemption. So if we'll just use the estate tax exemption, and throughout this I'm going to use an estate tax exemption of 7 million just for simplicity's sake, and also that is going to be about what the estate tax exemption is going into the future. We think Congress can do anything, but if the law stays as it is, it will go down to about $7 million. Okay, so in this example, we have Susie and Ed. They each have $7 million. Susie passes away, leaves everything to Ed. Ed now has $14 million. But Ed can also inherit, basically, Susie's estate tax exemption of $7 million. So he now has an estate tax exemption of $14 million. So when he passes away and leaves things to his kids, then there's not going to be any estate tax. It is important to know that it's not an automatically inherited. You do have to file a request to the IRS to get that, be able to use a deceased spouse's exemption. But this basically allows spouses to double their exemption, right? If it's 7 per person, 7 million per person, then you're really looking at a combined $14 million. And if the exemption is 14 million, then you're looking at $28 million. The New York's estate tax is a little different. So just like your income taxes, these are on top of one another, basically. So the New York estate tax is a separate tax. The estate tax exemption in New York is almost 7 million. So that's also a reason why I'm using 7 million, because it's about what the New York state exemption is as well. In New York, it's a little bit different in terms of how it works. There is no gift tax. So you can give it away during your life, pretty much any amount, and it's not going to be subject to New York estate taxes. There's a little bit of a caveat to that, and that's if you gift away money within 3 years of your death, then that's going to be pulled back into your estate. There's no tax, again, on bequests to no tax on any gifts to anybody, but no tax on bequests to spouses. It doesn't matter if your spouse is a US citizen or not. That doesn't matter for New York estate tax purposes. The tax rate for New York estate tax is a lot lower than the federal rate. It's a progressive rate from 8% to 16%. And by progressive, what I mean is that it goes up as the value of your estate goes up. So if you have an estate of, say, $8 million, maybe the estate tax rate will be 10%. And if you have an estate of a value of your estate is $11 million, then the estate tax rate is going to be 16%. And importantly, for New York, we have what is called an estate tax cliff. Sometimes we refer to it. And that basically means that, for the federal level, that 40% tax is only on the amount that exceeds your exemption amount. In New York, that tax is going to be, this 8 to 16% is going to be on your entire estate. So if you have an estate of, we'll say $8 million, then that estate tax is going to be on that $8 million, not just on that 1.06 million that's over the estate tax exemption. So what that means in practice is that the New York state often can be more than, the New York estate tax can actually be more than the federal estate tax in certain situations. Also importantly, in New York, there is no spousal portability. So that, we'll say $7 million, it's basically between, it's for each of you, but if one person passes away, they can't utilize the former spouse's or the deceased spouse's exemption. So they still only have the $7 million exemption. They don't get that benefit of at the federal level where you would have the combined $14 million. So we'll talk about what that means in terms of the implications for planning to be able to maximize both spouses' exemptions. Okay, this is just a little bit of an overview of the value of your estate. I just have a question here. What is considered qualified educational expenses? Good question. Is it only school or would childcare also apply? It is only school. I think it can be primary school or higher education, I don't think that childcare applies to them, unfortunately. But I would say that childcare isn't a gift to your child. Like, you have to care for your child, so that actually doesn't count as sort of a transfer to them. But if your parents were paying for your kids' childcare, then that would be basically, it would be a gift to you. But they can pay for, and we'll get actually to this, I have a slide for later to go into this in more detail. Okay, so back to calculating the value of your estate. Basically, what the value of your estate is for estate tax purposes is your net worth plus any life insurance proceeds. A lot of people don't realize that life insurance is included as part of your estate for estate tax purposes. I know a lot of life insurance agents out there will say, oh, life insurance is tax-free. It is income tax-free. It is not estate tax-free unless you do specific planning for it. So this is an example. Say you have a condo, it's worth $2 million. You have a brokerage account of $2 million. You have life insurance of $5 million, and there's $1 million mortgage on your condo. The value of your estate in this scenario would be $8 million. So that's just kind of the simple scenario of how you do that calculation. And then what you would do is say the state tax exemption, say you had $7 million of estate tax exemption, then that means that $1 million would be subject to tax at the federal level. If you, and in New York, that entire 8 million would be subject to estate tax. Okay, here's another example, and it also kind of lays out a little bit how the gifting rules work. So in this example, John gives each of his kids, 3 kids, $18,000 per year, plus $1 million each during his life. That $18,000 per year, it has no effect on his estate tax exemption. So he can actually gift out a lot of money that way, and it's not going to have any effect on estate taxes. And John's assets at his death are $3 million and $5 million in life insurance. His remaining exemption, because he gave away $1 million to each of his 3 kids during his life, he now has $4 million remaining of exemption. And so basically we take the 8 million minus of the value of his estate, minus the 3 million that he used in terms of his exemption, and we get a $4 million exemption left. So his $8 million is taxable estate. Actually, I think this is going to be, correct me if I'm wrong, Joe, this should be $5 million here. Oops.
If we're assuming a $7 million exemption, he gives away 1 million to 3 kids, that would be 4 million left over. 8 million in estate minus the $4 million exemption is the $4 million taxable estate.
Okay, great.
Yep, you're good.
Okay. Okay, so we have $4 million that's taxable at a 40% rate. Federal estate tax due is going to be about 1.4 million. New York estate tax due is going to be about 773,000. Total estate tax due is going to be $2.37 million. So that's the amount we're looking at in terms of estate taxes, the money that will be used up in estate taxes. So there are a number of ways that we can reduce that amount. And one of these ways that we mentioned is tax-free gifting. So even though in the previous example, there is still a lot of estate tax, it would have been even more if John had not been gifting out every year that $18,000 to each of his kids. And also, if John is married, he can actually give twice that amount to each of his kids. If you have young kids, then maybe giving them $18,000 a year each, to a 15-year-old is not a great idea. So often what clients do is they will make that gift into a trust. so that they can still control the money and the money is put away for a time in the future when your children will be mature enough to make decisions about it and manage it themselves. Also, and this is what we had mentioned before, this had come up, payment of educational and healthcare expenses. What's important, one of the important things to know about this is that you must make the payment directly to the healthcare provider or the educational institution. You cannot write a check to your child or to a grandchild and then they use it to pay the tuition, or you can't give it to a child, like an adult child, to pay their child's tuition. That's not going to fall into this exemption. You have to make that payment directly to the educational institution. Another way of planning, this is for specifically for New York State, for that because there is not spousal portability, you're not able to utilize both of the estate tax exemptions. So there is a way that we can do that. So here's an example where we have John has an estate of $6 million. Elaine has an estate of $6 million. John dies, leaving everything to Elaine. There's no estate tax when John leaves everything to Elaine because she is a US citizen spouse. So now Elaine also can inherit John's unused federal estate tax exemption. So for federal estate taxes, Elaine now has $12 million of exemption. So when she passes away, she has the $12 million, her estate plus John's estate. For federal estate tax, there's no estate tax because she can use hers and John's estate tax exemption. But there is a New York estate tax. So this is one example where, you know, we have a big New York estate tax, but no federal estate tax. And that can be pretty substantial. We have $1.38 million in estate taxes here. So fortunately, there is a way to plan around this. And that is creating, we call it a family trust, leaving assets to a family trust. Legally, it's often called a credit shelter trust. What we do here is that the first spouse to pass leaves their assets to a trust for their spouse and their kids. The money that goes into that trust does not become part of the surviving spouse's estate. So it maximizes both spouses' New York State estate tax exemption. So you can see in this example, the same example that we had before, instead of John leaving everything to Elaine outright, John leaves everything to a family trust for Elaine and their kids. And Elaine can be the trustee of that trust. She can manage that trust. She can have quite a bit of flexibility, but it does not go into her estate. It does not become part of her estate. So she still only has a $6 million estate. So on her passing, there's no estate, no state or federal estate tax. And the assets that were in the family trust are distributed to the kids. And I see there's a question. What if you are no longer married or have a spouse? Then you just have your own exemption. You cannot use like a former spouse's exemption. So unfortunately, that goes along with the ex-spouse. Okay, another common way of planning for estate taxes is a life insurance trust. So life insurance can be a big part of a person's estate, and this is a little bit, we'll say, usually we think of the estate as your assets. Life insurance is not really your assets. It's something that will pay out in the future. So it's not really necessarily worth much, if anything, during your life. So you may be paying out, paying premiums every year, especially if it's a term policy. You're not actually, there's no accumulation in that. You're just paying it in case you pass away. So you could end up with, you know, instead of here in this situation, John's assets at his death would be $3 million, but he has that $5 million in life insurance. So instead of, so that life insurance is included in his estate, which you might not sort of be intuitive. And we have all of these taxes, which we went over before. But if instead John purchased his life insurance policy through a life insurance trust, then it's removed from his estate. So here we have the assets at death are $4 million. His $5 million is not included in his estate. And this is actually, this number is wrong. His assets should be $3 million. The value of his estate would be $3 million, and total estate tax would be nothing because that's under his estate tax exemption, what he has left. Okay. Okay, we do have a question about does that apply only to immediate family, or can the trust be applied to nephews, nieces, and others? Yes, that can. The family trust can definitely, or this life insurance trust, you can name whatever beneficiaries you want. So that's fine. If you wanted to leave money to other people, you can definitely do that. Okay. So those were, we've sort of to this point has been estate tax strategies that aren't too complicated. Estate tax freezing is a little bit more complicated, and it's also a little bit more of a trade-off. Joe, do you want to give us a little bit of an overview on what it means to kind of like freeze the value of your estate?
Sure. So with these different freeze techniques, what you would do is you would put the asset into a vehicle, and at that point, you're going to pay a gift tax on a certain portion of that based on whatever the calculation is. But while it sits in the trust, the asset will continue to grow and appreciate in value. So all that appreciation will then pass on to your whoever, your beneficiaries, your children, grandchildren, tax-free. So essentially what you've done is you've paid a small amount of gift tax to pass on a much larger valued asset.
Yeah. And so you can use this sort of, you just to utilize you're leveraging the time value of money. So an example, just a simple example, you make a gift during your life, say you transfer $2 million to a trust for your kids or for anybody else. And 10 years later, that $2 million is now worth $4 million, but you've only utilized $2 million of your exemption, but you got out eventually $4 million from your estate. The quicker that asset appreciates, the more that asset appreciates, the more effective this strategy is. And this is often used by startup founders or people who have stock in smaller companies, because you can get assets out of that stock out of your estate for very little amount of exemption utilization. So sometimes that stock is worth very, very little, and then it could end up being worth millions and millions of dollars later on. So this can be very, very effective with respect to assets that have the potential for a really high return. And just a recap, just sort of some of these strategies. We have tax-free gifting, that is sort of very basic planning. You don't need any trusts or really much for that. The family trust, making sure you're minimizing your New York State estate taxes if you're married. A life insurance trust, removing your life insurance from your estate, and estate freeze. And that estate freeze, you can do it as a simple gift, but you can also do it, there's all kinds of more complicated and advanced planning techniques that we can use for estate freezing or other types of strategies that are more complex that I'm not going to get into because they're not used as frequently, but these are kind of the basics that if you were starting out, it's really good to understand these concepts and maybe utilize some of them. Okay, and that's it. That's our overview of our estate tax planning 101. I know we had some questions during the program. Oh, here's some more questions. What are the fees for setting up and maintaining a trust? It really depends, but probably it's going to be somewhere around $4,000, $5,000 to set up a trust. And then there's not really any maintenance costs. You or your spouse can be a trustee of that trust, and there's not really, as long as you sort of make sure everything gets done on a regular basis, then there's nothing that you need to necessarily pay a lawyer for. Does the life insurance have to be a trust from its inception, or can it be converted? That's a really good question. Ideally, life insurance is purchased in the trust. That's because it will automatically, immediately be outside of your estate from its inception. However, if you have life insurance that you want to put into a trust now, you can do that. The one caveat is that there is a 3-year look back period if you do that, if you transfer the life insurance into the trust. So it's not out of your estate for 3 years after you transfer it to the trust. So we usually do recommend that the life insurance be purchased in the trust, ideally, but certainly if you have a policy that you already purchased, you can transfer it into a trust. You also might want to look at, maybe it just makes sense to just let that policy lapse and just purchase a new policy. It really depends on what the situation is, like what fees you're paying. Would the premiums increase, or could you basically just get the same policy? It could be worth it to change the policy. Okay, any other questions?
There was one more that popped up, Shannon.
Yes, thank you.
Yep.
Are these government guidelines changeable with each government? That's a good question as well. Yes, so this is what we've gone over, are the laws that are currently in place. All of these rules can change, even if the government doesn't change. Congress can just pass a new law, or New York legislature can pass a new law. So these are, unfortunately for us, they are constantly changing. This is sort of always a moving target. We're always somewhat predicting where this is going to be in the future. It's definitely more of a art than science. So we just basically try to work with what we have, but also looking into, if things change, that this can also change in the future. Thank you for this informative presentation. So, thank you. I'm glad that this has been helpful. Joe, do you have anything you want to add?
No, I think everything's, been covered very well.
Okay, great. So, so if you have any further questions, feel free to reach out to us. If you've been on this presentation, we're happy to do a consultation with you at no charge. But hopefully this has been helpful, and we thank you for joining, and we hope you have a wonderful day.
Thank you.